Hi friends, my name is Nilesh Phadke. In this video, we will mainly learn about the cash flow statement. Cash flow statement is very important statement along with the balance sheet and profit and loss account. Cash flow statement basically indicates how the cash comes into the business and cash goes out of the business. Whenever cash comes into the business, it is called as a sources of funds in the cash flow statement. And whenever cash goes out of the business, it is called as an application of the funds in the cash flow statement. The closing balance of the cash flow statement always matches with the face of the balance sheet's cash amount. So let's learn cash flow statement. Basically, to prepare a cash flow statement, you need 2 years of balance sheet and you compare year 2 balance sheet versus year 1 balance sheet. So let us try to understand cash flow statement by considering first asset item of the balance sheet. So there are various items on the balance sheet which appear on the asset side like debtors, inventory, cash and bank balance, investments, etc. So let's learn how cash flow statement is prepared in respect of the assets item of the balance sheet. Now cash appears on the balance sheet asset side also and debtors appear also on the balance sheet asset side. So if we increase the debtors, that is one item of the balance sheet asset side. To tally the balance sheet, we have to reduce the cash. That is the other item of the balance sheet asset side. And hence, increase in the debtors is always a application of the funds, as increase in the debtors results into a reduction in the cash to tally the balance sheet. Now let us consider the situation of inventory. Let us say there is a reduction in the inventory between the two balance sheet dates. Now inventory appear on the balance sheet asset side only and cash also appears on the balance sheet asset side. So reduction in the inventory results in the increase in the cash to tally the balance sheet. As one item of the balance sheet, that is inventory, reduces, to tally the balance sheet, you have to increase the other item of the balance sheet asset side, that is the cash. And hence, reduction in the inventory is always sources of the funds, as is results into the increase in the cash. Now let us consider few items from the balance sheet liability side. On balance sheet liability side, there are basically share capital, trade payables, bank overdraft, loan from the banks. So let us consider 2-3 cases. Now if there is an increase in the creditors on the balance sheet liability side, then to tally the balance sheet, we have to increase the cash. As the creditors appears on the balance sheet liability side, if we increases it to tally the balance sheet, we have to increase the asset side with the equivalent amount to tally the balance sheet. And hence increase in creditors results into the increase in the cash to tally the balance sheet, and hence increase in the creditors is always sources of the funds. Similarly, if there is a reduction in the bank loan from the balance sheet liability side, then to tally the balance sheet, we have to reduce the asset side also to tally the balance sheet. And hence, repayment of the bank loan or reduction of the bank loan, which results into the reduction on the balance sheet asset side to tally the balance sheet, and hence reduction in the balance sheet liability side or bank loan is always the application of the funds. Thus, basically, we have to consider four cases here. First, if there is an increase in the balance sheet asset side item other than the cash, like debtors, inventory, you have to reduce the cash to tally the balance sheet. And hence, increase in debtors, increase in inventory, increase in investment is always application of the fund. Similarly, if there is a reduction in the debtors, investment, or inventory, to tally the balance sheet, you have to increase the cash, and hence reduction in the debtors, reduction in the investment, reduction in the stock, that is the items appear on the balance sheet asset side, which results into the increase in the cash, are always sources of the funds. Similarly, on the balance sheet liability side, If there is an increase in the liability, like increase in bank loan, increase in bank overdraft, increase in share capital, then to tally the balance sheet, you have to increase the cash. And hence, all these items, that is increase in creditors, increase in loan, increase in share capital, are all sources of the funds. Similarly, if there is a reduction in the balance sheet liability side items, like reduction in the bank loan, reduction in the creditors, reduction in the share capital, all these results into the reduction in the cash on the balance sheet asset side to tally the balance sheet. And hence, all these items, that is reduction in the creditors, reduction in the bank loan, reduction in the share capital, are all application of the funds.